Over the last 10 years, the average US fund returned about 8% a year. The average investor in those very same funds earned about 7. Same funds, a full percentage point less every single year. And not one bit of that gap came from picking the wrong thing. It came from when people bought and when they sold. That gap has a cause, and it isn't bad luck. It's 4 reactions, 4 mistakes that feel completely reasonable in the moment. We are going to walk through all 4, and by the end we are going to build a simple portfolio. Just 2 funds that makes every one of those mistakes structurally harder to commit, even on a bad day. It is the question I want us to sit with the whole way through. If the real drag on a beginner's return isn't stock picking, if it's behavior, then is there actually a way to build a portfolio that protects us from our own worst instincts? And the gap is not small. Picture 2 people who buy the very same funds and pay in the very same amount every month. One simply stays the course, the other keeps reacting, buying high, selling low. Over 30 years, that 1 percentage point a year leaves the calm one with roughly a third more money. Same funds, same market, the only difference was behavior. We will build the answer by the end, but first, the 4 behaviors themselves. Hey, I'm João. Welcome back to Investing Basics for Beginners. Over the last 5 episodes, we have built the foundation together. From why investing matters and how inflation quietly eats idle cash, all the way to how to start with just $100. We know why we are doing this and we know how to begin. Now it's time to protect all of that. So here is the plan. 4 mistakes in order. Chasing hype, panic selling, ignoring fees, and going with no plan. Then we take everything we have learned and build one simple portfolio that defends us against all 4. Mistake 1. Chasing hype. It goes like this. Something has been climbing for months. It's all over the feed, friends are talking about it, and a quiet voice says everyone's make money but us. So we buy. The problem is timing. By the time something is everywhere, the easy money has usually already been made, and the risk is at its highest, not its lowest. The people who got in early are the ones sharing their gains, and that's exactly what pulls the late arrivals into buy the top. We have watched this same movie more than once. The dot-com bubble, the crypto cycles, the meme stocks, different story each time, identical shape. I felt that pull myself. 6 years working as a developer inside the crypto and finance world, I've watched things go vertical and felt the part of my brain that whispers, don't miss this. The difference was never being immune to the feeling. It's having a rule that outlasts it. Mine is simple. The boring, diversified, low-cost ETF is a default. The decision that requires no decision, and anything that feels urgent and exciting has to sit for 1 week before I'm allowed to act on it. Most hot ideas don't survive the wait. Mistake 2 is the mirror image of the first, panic selling. The market drops, the numbers red, the headlines are loud, and every instinct says get out before it gets worse. Here is the context that instinct is missing. A 10% drop isn't a rare catastrophe. It's routine. JP Morgan's data shows the average year sees the market fall about 14% at some point along the way, and yet it still finished the year positive around 3 times out of 4. And selling into one does something permanent. It turns a paper loss, a number on a screen, into a real one, because we only actually lose money when we sell. Stay, and history has been remarkably clear. The market has recovered to new highs after every single major decline of the last century. Now, recovery isn't always fast, and I won't pretend it is. Take the worst case, the Great Depression. We have all learned it took about 25 years to recover, but that number counts prices alone and quietly ignores 2 things. The dividends investors keep reinvesting the whole way down, and the deflation of the decade, which made every surviving dollar buy more. Count those in, and the real recovery was far shorter, closer to 4 or 5 years, and the deepest crash of the modern era, 2008, down about 57%, was back to new highs in roughly 5.5 years. Patience isn't a nice to have here. Patience is the actual mechanism that turns a downturn into nothing more than a bad season. Two mistakes down, and they both came from the same place, reacting emotionally to a number moving, and it is the part that should make us pause. It was never about being a better stock picker in the first place. S&P keeps a running scorecard on the professionals, and over 20 years around 9 in 10 active fund managers failed to beat a simple index fund. If the full-time experts can't reliably outpick the market, then for us the edge was never going to be in selection. It's in behavior, in simply staying the course. Two more behaviors to go, then we build a portfolio that answers for all four. Mistake 3 is the quiet one, ignoring fees. It's invisible, so it never feels like a mistake. A small percentage gets taken automatically and we never see the money leave, but small isn't small. Take the US Department of Labor's own illustration. One extra percentage point in annual fees compounded over 35 years erased roughly 28% of the final balance. Not 28% of the fee, 28% of everything we had ended up with. The reason it bites that hard is that compounding works against us here. The fee is charged every single year, including on all the growth that money would have gone on to earn. Now the real world numbers. The average actively managed US stock fund charges about 0.60%. A plain S&P 500 index fund, Vanguard VOO for example, charges 300. That's a gap of more than half a point every year for owning essentially the same thing, and the genuinely expensive funds make it worse. 2% against an index fund's 300 over 30 years can cost around 40% of the final result. The difference is almost insultingly simple. Check the expense ratio before buying. For a broad index ETF, somewhere around 3 to 0.15% is normal. Anything much higher needs a very good reason, and if you want to actually see it, head to joaofreire.finance and open the compound interest calculator. Put in the same monthly amount twice, once at 0.03% and once at 1%, and watch the gap quietly appear. I built those tools for exactly this. We can compare everything. Mistake 4 is the one underneath all the others. No plan. Without a plan, we are not really investing. We are just reacting. Reacting to headlines, to the market's mood, to whatever a friend just bought. Every one of these first 3 mistakes walks straight through the door that a missing plan leaves open. And a beginner's plan doesn't need to be complicated. It answers 4 questions. What's the goal? What is the money actually for? How much goes in each month? Then what does it go into? And when do we review it? Once or twice a year, not once a day. That's it. Write those 4 answers down and something quietly powerful happens. Almost every short-term temptation already has its answer. Decide in advance while we were calm. The market drops, the plan already said stay and keep contributing. Something running hot on the feed, the plan already said that's not what we do. The plan pre-makes the decisions we had otherwise make at our worst, in fear or in excitement. It costs nothing, it takes about 30 minutes and it's the single highest leverage thing a new investor can do. Which brings us back to the question we planted at the start. Can we actually build a portfolio that makes all 4 of these mistakes structurally harder? The answer is yes, and it's simpler than almost anyone expects. 2 funds, roughly 80% in a broad US stock ETF, an S&P 500 or a total market fund, and roughly 20% in a broad bond ETF for little stability on the rough days. That's the whole thing. Low cost, broadly diversified, almost no maintenance. We contribute every month and we rebalance maybe once or twice a year. And watch how it quietly closes every door. Owning the whole market in one fund means there is no single hot stock to chase. Mistake 1, gone. The bond slice cushions the drops, which takes the pressure off the urge to panic sell. Mistake 2, softened. Index ETFs at 0.03% mean the fee mistake is handled by default. Mistake 3, gone. And the fixed, simple structure is itself the written plan. Mistake 4, answered. That 80-20 split isn't something I'm inventing. Vanguard published it as one of their named model portfolios, and over the long run, from 1926 to 2019, that mix returned about 9.5% a year. It's not magic, and it's not the only right answer. The younger we are, or the more comfortable we are with risk, the more we might lean 90-10 or even all stocks. The closer we are to actually needing the money, the more we lean 70-30 or 60-40. A rule of thumb some people use is 110 minus our age in stocks, so around 80% at 30, 70 at 40. It's a starting orientation, not a law. The real point, pick a ratio you will actually stick with and start. Simple, held for decades, beat celebrate every time. So the 4 mistakes, one line each. Chasing hype, by the time it's everywhere, the easy money is gone. Panic selling, a drop is only a loss if we sell. Ignore fees, small percentage quietly eat decades of growth. And no plan, without one, we just react. If there is one thing to do today, it's this. Look up the expense ratio on whatever we are invested in right now. If it's above 0.15%, ask why. Then pick a ratio, write down the 4-question plan and make one contribution this month. That's the whole game. Next episode, episode 7, we tie it all together. Everything across this series, inflation, the building blocks, passive investing, the first $100 and these 4 pitfalls comes together into one complete roadmap, from the very first dollar invested all the way to financial freedom. If this was useful, subscribing keeps the series going, so episode 7 lands the moment it's out. No hype, no rush, we are just walking this road together, one step at a time, and I will see you in episode 7.